Hey guys, it's Mr. White. It occurred to me that some of you may not know what a bond is, so let's real quick talk about what a bond is so that you don't feel super confused every time we talk about these. Also, I want to talk to you about how bonds are valued and what happens with bond values when interest rates change. So first of all, guys, a bond or a treasury security is just an IOU from the US government. It's a way that the government can borrow money and pay you back later. Um, the way that a bond works is it always has a face value. The face value is the amount that you have to pay for the bond, right? It's the upfront amount of the bond. The bond will be repaid within a certain period of time. That's when the bond matures, okay? The amount of time that it takes for them to pay it back to you. When the bond matures, they repay you the face value, which is the amount that they borrowed from you in the first place, plus interest. And the interest comes to you usually on an annual or a semi-annual basis. So either they pay you a check once a year for the interest, or they give you a check like twice a year for the amount of interest that you're supposed to get for a whole year. So let's say, for example, let's say if this bond that we're looking at right here, let's say if it was a 5% bond, okay? Let's just use that as an example. That would mean that they're going to pay you 5% of $500 until the bond matures. Maybe this bond matures in, let's just keep it simple, 5 years. Okay, so that means that every year for 5 years, you're going to get 5% of $500. Then in the very last year, you'll get a final payment of 5% plus the initial $500 that you invested. Okay, that's how a bond works. So as you can see, bonds are valuable assets, right? They're worth something. But the problem with a bond is it's not very liquid. In other words, you can't go to the grocery store and buy groceries with a $500 bond. Now, the reason why people buy these bonds is because they're an investment and they're extremely safe. The US government is very trustworthy and has never defaulted on its bond obligations before. So that means that the US government has never ever failed to pay back one of these bonds. As a matter of fact, sometimes we refer to these as the risk-free investment. And the interest rate on one of these is called a risk-free rate of return for that reason. Now, bonds, once they're purchased, don't have to sit around until they mature. If let's say, for example, if you bought this $500 bond at 5% for 5 years, and then let's say like a year later you decided you don't want it anymore, you just rather have the money. Well, you can resell this bond to somebody else and people will buy it from you. But the question is, how much are they going to pay for it? Well, the selling price depends on whatever the current interest rate is. So as I said, the bond has a face value, like $500. That means on the day when the bond was issued, that's how much it was worth, $500. And the interest rate they put on the bond is whatever the market interest rate was on the day when the bond was issued. So on the day when this $500 bond was issued, the market interest rate was 5%. Okay? Now, over the next 5 years, the market interest rate is going to fluctuate and change. If the market interest rate goes up, like let's say, for example, if the current market interest rate is like, I don't know, let's say it went up to 7%. Okay. If the market interest rate went up to 7%, nobody's going to really want to buy our bond from us if we try to resell it. Because just think, if you had an option between buying a bond that gets 7% interest or a bond that gets 5%, which one are you going to choose? You're going to choose the 7%, right? It's pretty easy. So that means that if you were trying to resell this bond and you're saying, hey, buy my bond, it has 5% interest. Well, people are going to say, you know what? I'll just go buy a brand new bond that gets 7%. So the way that you could entice somebody to buy your bond is by offering them a discount. The bond price will go down. So when interest rates are 7%, maybe you'll sell that bond for $475, okay? In other words, you're going to give them a big discount on the face value. And at the end of 5 years, they're still going to get the full $500, and they're still going to get 5% of $500 for that time. And that explains the whole reason why they get this big discount, okay? Now, you might be saying, okay, well, you know, that's if the interest rate goes up, but what if the interest rate goes down? Well, if the interest rate were to go down, like let's say if the interest rate went down to something like 4%, okay? When the interest rate goes down, well, now all of a sudden your 5% looks very attractive to everybody. And so if you try to resell your bond, everybody's going to want to buy it. But If you resell your 5% bond, that means that if you try to go out and buy another bond today, you can only get 4%. So you're going to want to be compensated for this very valuable bond. And so what you're going to do is you're going to charge a premium, meaning that the bond price is going to be higher. So instead of just charging $500 for this bond, maybe you'll charge like $520 for this bond. That means that if anybody wants to buy your bond, they're going to have to give you $520. That means that after 5 years, they're not even going to get the amount they initially put into it. But the thing that they will get that's very valuable, and the reason why somebody might still be willing to buy your bond even for $520 is because it's earning 5%. And there's no other bonds out there right now that are earning 5%. So the main thing I really want you to know is that there's an inverse relationship between bond prices and interest rates, and this has a big implication for monetary policy. We know that with monetary policy, the Fed changes interest rates. So if the Fed makes interest rates go up, that means bond prices in the economy are going to go down. And if the Fed makes interest rates go down, that means that bond prices in the economy are going to go up. Something you need to know. They like to ask about that on the AP test. And there's even, I think, 1 or 2 questions on some of your Check for Understanding assignments where you need to know that. So if you have any questions about this, guys, feel free to email me or holler at me in class. Otherwise, have a great day.